If Washington eliminates the capital gains tax on home sales, the single biggest winners in the entire United States will be longtime San Francisco homeowners. We're talking about six-figure tax savings on a single sale. In California, roughly 44% of homeowners have already blown past the federal exclusion cap, the second highest rate in the nation. And if you bought in the marina or the air in Richmond 20 or 30 years ago, you're almost certainly one of them. In the next 10 minutes, I'm going to break down exactly what's on the table in Congress for the capital gains tax on home sales, who actually benefits, the trap in waiting for it to pass, and most importantly, the strategies that work under the current law right now. And stick around, because the last point is the biggest, the one move stack that can save a SF seller more than any bill in Congress. I'm David Poulsen, top San Francisco realtor. My family's been in the San Francisco Bay Area for generations, and I've spent 30 plus years navigating this market. Reach out to me for real estate advice, as many of you do through YouTube. Point one, you're probably already over the cap. Point number one, if you've owned a SF home for more than about 10 years, you're probably already over the exclusion. And most owners don't realize it until escrow. Here's the current law. When you sell your primary residence, you can exclude $250,000 of gain if you're single, $500,000 if you're married, filing jointly. Those numbers were set in 1997, when the median U.S. home price was around $129,000. They've never been adjusted for inflation, not once, almost 30 years. Now run the SF math. Say you bought a home in the inner Richmond in 1998 for $450,000. Now it's worth $2.3 million today. That's roughly $1.85 million of gain. Take out your $500,000 married exclusion, and you've still got $1.35 million of taxable gain. Hit with federal capital gains at 15 or 20%, likely the 3.8% net investment income tax on top, plus California state tax. The combined bite on the taxable portion can push past 30%. That's potentially $400,000 plus. Walking out the door. What to do instead before you do anything else? Get your actual number, adjusted basis, improvement, selling costs. I'll show you how to fix that calculation in point 5. But first, what is Congress actually proposing? Just a quick disclaimer. I'm a realtor, not a CPA or a tax advisor. Verify your specific situation with a tax professional before making any moves. Also, this video is for educational and entertainment purposes only. Point 2, what's actually on the table. So what exactly is Congress proposing for the capital gains tax on home sales? 3 different things, and they are not the same. First, the More Homes on the Market Act. That's the bipartisan one. It would double the exclusion to $500,000 for singles and $1 million for married couples, and finally index it to inflation going forward. It's been sitting in the House Ways and Means Committee. Second, the full elimination bill, the No Tax on Home Sales Act. No cap at all on primary residence gains. But read the fine print. Primary residences only. No second homes, no investment property, no flips, and it's not retroactive. It would only apply to sales after passage. Third, and almost nobody's talking about this one, a Republican study committee framework from January proposed eliminating capital gains entirely on two specific transactions: homes sold to first-time home buyers and rental homes sold to tenants living in them. Remember that second one. I'm coming back to it with my Developer's Eye segment, because for SF duplex and multi-unit owners, that could be the sleeper provision of the decade. Number 3, proposals double it, eliminate it, target exemptions. By the way, if you're trying to figure out where your own property lands in all this, just call or text me at 415-735-6188 or send me a DM. Happy to run the numbers with you, but remember, I'm not a CPA. Okay, point 3. California doesn't care what. Here's what nobody tells you. Even if the federal capital gains tax on home sales goes to 0 tomorrow, California does not move an inch. California has no preferential capital gains rate, 0. The state taxes your gains as ordinary income up to 13.3% at the top bracket. On that enrichment example, with a 1.35 million of taxable gain, the state share alone can run well into 6 figures, depending upon your bracket. And one more California-specific landmine: escrow withholding. By default, the state withholds 3.33% of your gross sales price at closing unless you file Form 593 correctly, certifying your exclusion. On a $2.3 million sale, that's over $76,000 of your money sitting with the Franchise Tax Board until you file, just because of paperwork. What to do instead? Any sale plan in San Francisco has to be built around state tax, not just the federal headline. That's a planning conversation with your CPA before you list, not after. Point 4, the waiting trap. This is the mistake I'm watching people make right now. I've talked to owners in Cow Hollow and Pacific Heights who are sitting on the sidelines telling me, David, I'll list when the tax cut passes. Here's the problem: none of these bills is law. One is parked in committee. The elimination bill faces a fight over hundreds of billions in lost federal revenue. And Brookings published an analysis concluding these changes would do little to actually change seller behavior, because taxes are only one of the reasons people stay put. So how long could you be waiting? It could be next year. It could be never. Meanwhile, life doesn't wait. The stairs don't get easier. The estate doesn't settle at sale. And the spring market you could have caught is gone. Here's the real kicker: if you die waiting, your heirs get stepped up basis and the gain disappears anyway, which means for some older owners, the wait for the tax cut logic is really an accidental never sell plan that might be right for you, but it should be a decision, not a drift. What to do instead? Make your plan under current law and treat any future tax cut as a bonus, not a strategy. Point 5, your basis is probably wrong. Point 5, here's one concrete thing you can do today. your gain is probably smaller than you think because your basis is probably understated. Your taxable gain isn't sale price minus purchase price. It's sale price minus selling cost minus your adjusted basis. And the adjusted basis includes every capital improvement you've ever made. The kitchen remodel in 2007, the foundation bolt, the roof, the rear addition with permits. I've seen SF owners with 25 years of improvements recover 200,000 or 300,000 a basis just by reconstructing records, permits pulled from DBI, contractor invoices, bank statements. Every dollar of documented improvement is a dollar the IRS can't tax. But if you can't prove it, the IRS can disallow it. The action item, start a basis file this week. Pull your SF department building inspection permit history. It's online, and start matching permits to invoices. That's free. It takes an afternoon. It might be worth 6 figures. Now, let me put my developer's eye, because there's a layer to the story that not only someone who's owned and built multi-unit property will see. Remember that reconciliation 2.0 provision: zero capital gains on rental home sold to the tenant living in it. Every other agent reads this as a footnote. I read it as a potential exit strategy for thousands of SF duplex and small unit owners. Think about who owns SF's 2 to 4 unit buildings. Longtime owners, often owner occupants, sitting on enormous gains, low Prop 13 basis, and tenants they can't easily deliver vacant. Today, selling that building means capital gains on rental portion plus depreciation recapture. That's the tax on all the depreciation you've written off over the years. Currently recaptured at up to 25% federally. And note that none of these proposals clearly erases recapture. A tenant sale exemption could flip the math. The problem tenant unit becomes the tax advantage exit. And here's the developer's caution on 2-unit building. Your basis has to be allocated between the owner unit and the rental unit. And how you've reported that building on your tax returns for the last 20 years locks in a lot of that math. If this provision ever moves, the owners who will win will be the ones whose records, unit allocations, and tenant relationships were structured years in advance. This is exactly the kind of entitlement style thinking I did as a developer. You position for the rule change before the rule changes. If you own a duplex or a small building in the Marina, Cow Hollow, or the Richmond, this is a worth strategy conversation now, not after the bill passes. Point 6, the moves that work under current law. And now the big one promised you. Point 6, the move stack that beats waiting for Congress, because it works under the capital gains tax on home sales as it exists today. Take a real profile: a married couple, empty nesters in a 2.1 million Edwardian in Cow Hollow they bought decades ago. Here's the stack. 1, maximize the $500,000 exclusion with a fully reconstructed basis, like we covered in point 5. 2, Prop 19. If you're 55 or older, you can carry your low property tax basis to a replacement home anywhere in California up to 3 times That protects the other half of the equation. Everyone forgets your annual property tax bill for the rest of your life. My partner and I are going through the downsizing process ourselves right now. And I can tell you the Prop 19 transfer changes the entire feel of the decision. 3, timing. Selling in a lower income year or structuring an installment sale to spread the gain can pull you out of the top federal bracket and reduce the 3.8% surtax exposure. 4, part of your property is a rental, a 1031 exchange can defer the gain on that portion entirely while the exclusion covers your residence portion. On mixed use and multi-unit property, splitting a sale this way is one of the most underused plays in San Francisco. And it's a hard rule. I'm a realtor, not a CPA. Every one of those moves gets modeled with your tax professional before you sign a listing agreement. So make sure you go talk to your CPA or tax professional. That's the point. The modeling happens before, and my job is to bring the right team to your kitchen table. If you remember one thing from this video, remember this. The smartest San Francisco sellers aren't waiting to see what Congress does with capital gains tax on home sales. They're getting their basis, their Prop 19 transfer, and their timing lined up under today's rules. So any tax cut is a windfall instead of a plan. Quick but important note, this video is for education and entertainment purposes only. It is not legal, tax, or financial advice. Tax law is complicated and your situation is your own. Please seek out the required consultants, a licensed CPA, a real estate attorney, and your financial advisor before you make any decision based on what I've covered here. I'm David Poulsen, top San Francisco realtor. My family has lived in the San Francisco Bay Area for 4 generations, and I personally spent over 30 years in real estate navigating this area's unique market cycles and sold hundreds of homes. If you're thinking about selling or you just want to know your number, call or text me at 415-735-6188. DM me here on YouTube. A lot of people do, and I answer their questions, or email me at david@sfhothomes.com. And if capital gains is the wall between you and your next chapter, watch my video on Prop 19 property tax transfer next. It's the other half of this exact equation for anyone 55 and over. This is David Poulsen coming to you live here in San Francisco's Washington Square. Bye-bye, everyone. And do me a favor, hit the like button, hit the subscribe button. I sure would appreciate it.